Welcome, everybody. My name is Brent Hutzel. I am one of the professors and instructors of Accounting 1040. In this video, we are going to discuss and apply the three methods of amortization by taking a look at exercise 10-8. So let's read this together. It says, on January 1st, 2020, Murray Demolition, a Hamilton, Ontario company specializing in blasting and removing buildings, purchased and took delivery of a new dump truck to add to his growing fleet. Murray Demolition has a high-class reputation and uses only the best and newest equipment on their work sites. The business spent $140,000 plus HST on the truck, which is expected to be useful to the business for 4 years, at which time it should be able to be sold for $60,000. So lots of good information in this question already. We can see the asset cost, which is the historical cost. The purchase price is $140,000. We see that the expected useful life of the truck is 4 years. And we also see that the expected residual value or salvage value of the truck is $60,000. So let's continue. Murray Demolition has always used the straight line basis of calculating amortization. The new owners want to see the amortization schedules for straight line, units of production, and double declining balance methods, just to be sure that this makes sense. The business expects the truck to be useful for 200,000 kilometers, 60,000 kilometers in year 1, 50,000 kilometers in each of year 2 and year 3, and 40,000 kilometers in year 4. Is there a problem with continuing to use the straight line method? Okay, so let's take a look and ask ourselves what is being required of us in this question. We need to prepare the amortization schedules for each of the three methods and answer the question at the end of whether there is a problem continuing to use the straight line method. Let's start with the straight line method. Okay, just to refresh ourselves, what we talked about in class, straight line amortization is calculated by taking the cost minus the residual value divided by the useful life in years. And there's the calculation in front of you. We know that the cost is $140,000. We know that the residual value of the truck is expected to be $60,000. So we take 140 minus 60, which is $80,000, divide that by 4 to arrive at amortization expense of $20,000 a year. So let me change the screen share to Excel, and we can run through the amortization table, amortization schedule for straight line, which is requirement number 1. And we can see from this table, there's a number of fields that we need to complete. I wanted to point out the date column, first of all. You can see that there's 5 dates listed there, January 1st, and then December 31st for each of those 4 years. Now, on January 1st, 2020, the only thing that happened on this date was the purchase of the truck. Nothing else. There's no amortization to consider or account for on that date. So asset cost on January 1st, 2020 is $140,000. And the asset book value on that same day is the same amount, $140,000, because no amortization needs to be accounted for. We've only owned this vehicle for 1 day at this point. Okay, what I want you to take a look at next is the amortization rate column. Okay, and I know that the amortization rate is 25%. Well, how do I know that? Well, we know that the expected useful life of the truck is 4 years. Okay, the asset is 100% at the beginning of 4 years. In each of those 4 years, we amortize the asset by 25%. So we can actually use that same amortization rate for each of the 4 years. And that's the wonderful thing about the straight line method. The amortization rate will be the same, will be consistent in each of those 4 years. The amortizable cost. Now, we didn't talk about this on the slide, but the amortizable cost is just that asset cost, the historical cost, the price we purchased for the asset, which is $140,000, minus the residual value, the salvage value, which is 60,000. Okay, 140 minus 60. It's really the numerator of the calculation that we went through on that previous slide. You can think of this amount as the amount that will be consumed over those 4 years. And here's the great thing, just like the amortization rate will be the same in each of those 4 years, the amortizable cost will also be the same in each of those 4 years. Again, due to the fact we're talking about straight line. Okay, the amortization expense, this is what we calculated on that slide. Okay, if you go back to that slide, you'll see it was $20,000. Remember, it was just that amortizable cost divided by its useful life, 4 years. And again, it may sound like a broken record, but this is also going to be the same for each of those 4 years because we're using the straight line method. Okay, so amortization rate, amortizable cost, and amortization expense are the same for each of the 4 years. Each year of its useful life, those figures will remain the same. Next column that you see there is accumulated amortization. Now, this is one of those terms that sounds more complicated than it is. Accumulated amortization literally means just that. It's the amount of amortization that has accumulated. Okay, so after the first year, we've accumulated $20,000 of amortization. Okay, the asset has only been owned for 1 year. But take a look what happens after 2 years. After 2 years, we have the amortization from last year plus the amortization for 2021. So in 2021, or at the end of 2021, we've accumulated $40,000 worth of amortization. Okay, if it's not clear yet, I'm sure it will be after we go through accumulated amortization for the next year. After 3 years, we have $60,000 of amortization accumulated. That's $20,000 a year for 3 years. And then finally, for 4 years, after 4 years, we've accumulated $80,000 worth of amortization. And the asset book value is the last column. Now remember, the asset book value is simply the asset book value from the previous year, or we can say, take a look at it in an easier way, the asset book value, which is the historical cost, minus any accumulated amortization. Any amortization that has accumulated over its life. So $140,000 minus $20,000 worth of amortization that's accumulated after year 1 gives us an asset book value of $120,000. After 2 years, the asset book value is $100,000. How do we get that? Well, $140,000 is the historical cost, and now we've accumulated $40,000 worth of amortization. Asset book value is $100,000. We continue that trend, and we can see that the asset book value after 3 years is $80,000, and the asset book value after 4 years is $60,000. Again, asset book value is just the historical cost minus the accumulated amortization. So 140 minus $80,000 in that case will give us $60,000. Now here's a tip. When you've completed the amortization table for straight line, I want you to take a look at the asset book value at the end of the 4th year in this case, or for any question at the end of its useful life. And this asset book value should be the same as the residual value, because that's the amount left over, so to speak. That's the amount that we expect to be able to sell the asset for. So this is the tip, because if you do take a look at this before you move on, okay, you can determine whether you're on the right path. And in this case, because we've calculated the asset book value at December 31st, 2023 to be $60,000, and we know that the residual value is also $60,000, we know we're in good shape. Okay, so let's move on to the next method. And I'm just going to change the screen share back to our slides. Before we run the numbers, let's remind ourselves of what the next method is all about. It's the units of production method, also designated as UOP. And you'll recall in class, we talked about units of production amortization being cost minus residual value divided by the useful life in units of production. Now, the numerator of that equation, the top part of that equation, is going to look very familiar to you. It's identical to method number one. We take the cost and we minus the residual value. So right off the bat, we know we have $80,000 as the amortizable cost. But instead of dividing it by its useful life in years, we divide it by the useful life in units of production. So we take $80,000 divided by 200,000 kilometers. If you take a look in the question, you can see that's the number of kilometers we expect this vehicle to last us. Okay, so using that calculation, running those numbers through, we determine units of production amortization per unit of output to be 40 cents a kilometer. Now we take that figure, 40 cents a kilometer, and in step two, we multiply that by the number of units produced or used in the period. In this case, we'd multiply 40 cents a kilometer by the number of kilometers driven in each year. So let's do that. Let's change the screen share. Back to our Excel calculations, we're going to move on to units of production. And this is the next amortization schedule that you see. Okay, and we're going to use the exact same question. Okay, Murray Demolition bought the truck for $140,000. And remember, on January 1st, 2020, there's nothing else we need to enter in this row except for these two figures, the asset cost and the asset book value, because the only thing that happened on this date was we purchased the truck. Okay, for the next four rows, the next four dates that you see here, we do need to account for amortization. Okay, so for units of production, like we calculated on the previous slide, amortization per kilometer will be 40 cents per kilometer. Remember how we calculated that? 140,000 divided by the residual cost, which is 60, gives us $80,000 on the numerator, divided by 200,000 kilometers. I'm going to circle it right there. You can see the business expects the truck to be useful for 200,000 kilometers. Okay, what we do in column D is we enter the number of kilometers that we expect to use this truck in each year. So we can go ahead and complete this column for every year because we have all that information in the question. It says that we expect to use this truck for 60,000 kilometers in year one, 50,000 kilometers in year two, 50,000 kilometers in year three, and 40,000 kilometers in year four. If we add up those four figures, you can see that the sum is 200,000. So everything matches up in terms of the usage of kilometers. Okay, so amortization expense, like we said in step two on the slide, was we take the amortization per kilometer and we multiply it by the number of kilometers driven in that year. So amortization expense for 2020 is $24,000. Okay, remember, accumulated amortization is just the amortization that's accumulated so far. Well, we only have 1 year of amortization to accumulate, so it's also 24,000. Asset book value, like we talked about, is the historical cost, $140,000, minus all the amortization that have accumulated so far. Okay, so that's the row for December 31st, 2020 complete. I could have completed this column for every single year as well, and I probably should have, because this rate of 40 cents per kilometer is not going to change. That's a constant. What does change is the number of kilometers driven in the year. Okay, so for December 31st, 2021, we take 40 cents a kilometer, multiply it by the 50,000 kilometers we expect to drive it in that year, and we arrive at $20,000 of amortization expense. Accumulated amortization, just add last year's amortization with this year's amortization, and we get $44,000 worth of accumulated amortization. Okay, asset book value will just be 140 minus what we've accumulated to date, which is now 44,000. So asset book value is now $96,000. December 31st, 2020, because we also drive this vehicle for 50,000 in this year, these figures are going to be the same. Amortization expense will also be $20,000, 40 cents a kilometer multiplied by 50,000 kilometers. Accumulated amortization, what had been accumulated so far, plus the new amortization for this year. So 44 plus 20 is now 64. Okay, and the asset book value will be 76, which is 140 minus the accumulated amortization, which is 64, to give us an asset book value of 76. Okay, let's do the last row. 40 cents a kilometer multiplied by 40,000 kilometers. Amortization expense is 60,000. Accumulated amortization is 80,000, which is which is this year's amortization plus what had been accumulated at the beginning of the year to give us 80. 64 plus 16 is 80,000. And then finally, the net book value at the end of those 4 years will be 60,000. 140 minus accumulated amortization to give us 60. And look at that. The net book value or asset book value at the end of the 4 years is $60,000, just like it was using the straight line method. And that's exactly what we wanted to see, again, because the residual value of this asset is $60,000. So we should see asset book value of $60,000 on December 31st, 2023, which we do. Okay, 2 down, 1 to go. The last method we're going to take a look at is the double declining balance method. And let me change the screen share back to those slides. And we'll give you a little bit of a refresher on this method. And remember, this method is similar to the first method, straight line depreciation method. But what we're going to do is take that rate that we calculated for the straight line amortization method and multiply it by 2. Now, if you have a good memory, you'll recall that for the straight line amortization method, we calculated that amortization rate to be 25%. So for the double declining balance method, we're going to use 50%. Okay, take a look back at the amortization schedule for straight line, and you'll see that we use 25%. For double declining method, we will use 50%. Okay, let's use that 50% in our Excel template. We'll go to the last part of this question, exercise 10-8, using the double declining balance method. Again, asset cost will be 140. Asset book value will also be 140. On January 1st, 2020, again, the only thing that happened on that date was the purchase of the truck. There's no amortization to account for at that point in time. The double declining balance rate is 50%. Like we said, remember back on the first tab, the straight line amortization schedule, we determined that the rate was 25%. So for double declining, we will use a rate of 50%. The amortizable cost, okay, for double declining balance method, this is where it's a little bit different. We don't take out that residual value. Okay, we don't take it out for this part of the calculation. So the amortizable cost will be the asset cost. The amortization expense will be calculated the same way, 50% multiplied by the amortizable cost. So amortization expense is $70,000. The accumulated amortization, well, that's just going to be $70,000 because we only have 1 year accumulated so far. And the asset book value will be $140,000 minus the accumulated amortization. Okay, let's move on to the second year. December 31st, 2021. Again, the double declining balance rate is 50%. The amortizable cost is $70,000 in this case because that's what's left over. That's what's left to amortize. 50% multiplied by $70,000 will be $35,000. Accumulated amortization will be what we've accumulated so far, plus the new amortization expense. So now we have accumulated amortization of $105,000. Okay, the asset book value will be the historical cost of $140,000 minus all that accumulated amortization. Okay, I'm going to stop there because here's a big red flag. As we calculated the asset book value to be $35,000, maybe you caught it. In case you didn't, let's talk about this. Remember what we said. We said that the asset book value must be $60,000 in order to account for its residual value. Well, at this point, at the end of 2 years, we have an asset book value of $35,000. Why is that? Well, that's because the double declining balance method accounts for so much amortization expense at the beginning of its life. But here's the thing, the asset book value still cannot fall below $60,000. Okay, so we can change this to $60,000. What that does is accumulated amortization will only be $80,000, which means that amortization expense in the second year was only $10,000. Okay, we know that 50% multiplied by $70,000 is not $10,000. But like we said, we cannot let this asset book value fall below $60,000. So the amortization expense for the second year, the amortization expense on December 31st, 2021 will be only $10,000. Okay, and by doing that, we arrive at an asset book value of $60,000 and we're done the schedule at that point. Okay, this asset is fully amortized after those 2 years. So taking a look at those three methods and working through this exercise using all three methods, the very last question asked us, is there a problem with continuing to use the straight line method? Well, let's talk about that. Okay, a couple different things to consider. Management expects this truck to last 4 years. Management expects this truck to be useful for 200,000 kilometers. Okay, this truck is expected to play a role in this company for a certain period of time. Okay, hypothetically and conceivably for more than 2 years that we see using the double declining balance method. Okay, so both straight line and units of production will give us a realistic match of the amortization expense against the related revenues that we expect to earn. Okay, and the reason for that is that we expect this truck to play a role in our business over that period of time. And that matches it better. Those expenses related to amortization expense are matched better against the revenue using straight line and units of production. Okay, so that being said, why don't we use units of production then? If you said that both methods give us a realistic match of amortization expense against revenues, why don't we switch over to units of production? One thing to consider, And you remember we talked about this back in our first class. We talked about this in Accounting 1030. There's this aspect of consistency. Now, a company typically will not make drastic accounting policy changes unless there's good reason to, very good reason to. And in this case, there is not a real good reason to change from straight line to unit of production. The company has been using straight line for a long period of time, and straight line method will continue to provide a realistic match against revenues, and will continue to use straight line into the future for consistency purposes. Thanks for watching. And if you have any questions, make sure to reach out to your professor. My name is Brent Hutzel, and thanks for tuning in.